What is the reward to risk? That is a fraud, by the way. Reward to risk is, you can simply calculate here, right? So 1361 divided by 30,000. So your reward to risk is 0.04%. I don't know whether this is even allowed. So you are basically taking 22 times more risk than the possible reward for you. But if you calculate it in terms of expectation, so 1363 was your expected reward divided by 324 is your expected loss. So in that case, it comes to around 4.20. This is excellent. Based on how you look at this strategy will decide what kind of reward to risk you are exposing yourself to. For me, I look at it in a completely different light, because if you rely on these calculations, they will confuse you to no end. Getting confused is alright, but what is the outcome of it? Nothing. If you go and tell someone that I am taking 22 times the risk of potential profit I am going to make, they will call you a madman. But if you look at it in terms of expectation, then things change dramatically, right? Now, which one is correct? Whether you should risk so much of your potential profit. The question here is again in terms of probabilities. Addition to it is what you can do before your maximum loss scenario actually plays out. Now, if it gaps down 2000 point tomorrow, we cannot help it. If it goes in the normal way it is moving, you get a lot of time. This is our bullish credit spread, right? The green band. So we have a lot of distance between it, and as it starts to come down and taking out one reference after the other, we have sufficient time to decide what we want to do with it. If it tags 37,300, this is an important HVN because this is the breakout day. You can start adjusting your position from here. If it breaks 37,300, you can roll it down and make sure that you go sufficiently away from the current market price and still break even. If it starts looking weak, you can establish a bearish credit spread for the short term for a couple of days, so that it gives you some additional income. That is the correct way to adjust. But here we are starting out with a clear directional bias, and you can see current market one time framing has never stopped. There is again another range extension happening. So let's say if it spikes and goes above 38,000 today itself, then in that case our position becomes even more safe. If it does not, and if it just stays there, then yeah, we have to come back tomorrow and reassess the situation. But this is how I like to be in a market, in a position where I get sufficient time to decide what to do with my trade if it goes wrong. Masters of the universe kind of traders and mentors, if you go and ask them, they will they will criticize this strategy like anything. But again, if those option buyers, they are trying to make 5,000, 10,000 from one lot or two lots in a matter of hours, because they are trying to catch the next breakout, the momentum, and it happens. I'm not saying that when there is a momentum, option prices do not jump. They definitely do. But if you want to catch those kinds of moves, your objective is completely different. You're speculating on capital gains. You're speculating that the prices of options will increase. If that is what you're aiming at, you have a completely different trading objective. You can then go to the market profile course and you can try to find out what are those times when there is a chance of a sharp move, or where the inventory adjustment break is very, very likely, so that it happens very quickly, and you can then use those scenarios to your advantage. It is decided by your objective. My objective is to make consistent income, and this strategy gives me that. On top of that, it gives me a good enough margin of safety, so if things go wrong, I can do some adjustments and try and come out of it on the positive side.